Hey guys, my name is Max Convexity. Thanks for tuning into my channel. Today I wanted to talk about the use of ladders in finance. You always hear me talking about they have a three-strike ladder or five-strike ladder. All right. Tom asked the question, Max, I've done calls for years. I've never done a ladder. Why would an individual do one? That's a great question, Tom. Thanks for asking. Okay, with Jay and the guys, they were actually talking about this at dinner in New York. They do it because of liquidity. They're trying to get thousands of contracts done. They're trading nearly $1 billion, strategies on some of these high yield, single stock funds. Now in the indexes, they have, tons of liquidity all day long. And I think they do in Tesla and Nvidia and Apple as well. But some of these ones don't have a lot of liquidity. So liquidity is a concern. They'll overwhelm a strike if they try to come in, with 1,000, and there's maybe only, there's only been 10 contracts done and 100 open at that strike. So they'll ladder in that case. There's also a game theory edge to laddering strikes. It reduces path dependency. Path dependency is something you're fighting when you're trading options. If you only have one strike, it's kind of the equivalent of having all your eggs in one basket. When you have strikes spread around, you're spreading the risk around essentially. Anytime you sell something short, you're obligated to perform on the other end, right? Even the covered call isn't really naked short. You're selling the call before you buy it. So on the other end, you have to deliver the stock at the strike price of the call. That's the other side of it. That's your trade-off. So if you do it at too low of a strike, then you're mad because you have to deliver you don't make as much. You have an opportunity loss in the cost of and how much you can receive for your stock, right? If you do a three-strike ladder, it makes it 3 times as hard to have all your strikes blown out, right? I mean, kind of, I guess, but there's nothing wrong with spreading risk around. I think it's usually a good idea. There's a famous quote, Thornton Wilder from the movie, or it was a movie and a Broadway play, The Matchmaker. Money's like manure. It's not worth a thing unless it's spread around, encouraging young things to grow. Okay, so here's a real life example of when a person might use a ladder. Okay, Mark's a software engineer. He's considering early retirement. He has a house and a rent house in Austin. He has 10,000 shares of Amazon he received while working at the company. He's an engineer at Amazon. He's been there about 20 years. He's heard that Amazon's going to have a really good earnings announcement when they announce this week. And he's ready to sell some stock. He wants to sell about half of his stock. He wants to raise $1 million worth of cash and then diversify it, put it in a diverse portfolio, still have some Amazon. He's going to keep 4,000 shares, but he's decided to sell 6,000 shares, take the hit on taxes. He's ready, okay? So he can just sell it outright and he makes 1.1 million. All right. So that gives him $1 million to do in a diverse portfolio and the 100,000 to pay taxes with, which isn't actually enough for all his taxes. But anyway, it's that's one option. Okay. He could also write an option, and he knows a little bit about options. He knows that when you write an option, you can sometimes get a little bit more money by writing an out of the money option. And you can also get some money in advance, the premium. So he understands it's sometimes a smart thing to do. And so he's looking into writing options as well. All right. So let's look at some alternatives for Mark. Now, one more thing. Mark's getting married and he needs $10,000 cash for the ring pretty quick, right? Okay. So let's do this. Let's look at, I have option strat loaded up with 3 alternatives. Here's alternative 1. Okay, here's Amazon. Amazon's trading at 183. The next even number strike is 190. Okay, I mean, they have 185s. We aren't going to mess with that. So we're going to call 190 basically at the money. I mean, it's 6 points away. Okay. So he could write the 190 call, what's called write it. So he owns the shares, then he sells. So he's selling the 190 call 60 times. These things are going for 385. All right, so that's $385 times 60. That's a lot of money. It equals $23,000 up front. The only problem is he's agreeing to sell all his Amazon at 190. Well, 190 is about a $60,000 premium for where it is now, so it equals 1.16 million. It's all right, but he really wants a little bit more money for his Amazon. He doesn't really need $23,000. That would be another tax bill. He's going to have to pay a capital gain on that as well. All right. Anyway, so alternative number 2 would be to go out to the 200. Okay, so same thing. He has a 6,000 shares of stock at 183. Same situation. He writes 60 calls. Remember, one call is worth 100 shares, so 60 calls worth 6,000 shares. So he's obligated to sell all his shares, or all 6,000 of his shares. Not all his shares, because he owns 10,000, but he's obligated to sell 6,000 shares. Okay. And these are going for $1.24. They're bid $1.24. So that's great news. He could sell these, and and then he could get 200 for the stock, and that's great. Oops, what's the problem? Problem is this is only a $7,500 credit. These options aren't going for enough. All right, well, then let's look. Option number 3 would be to go way out of the money, and this would be great. He'd really like to do this if you put a true serum in him. He thinks this earnings is going to be great and it's likely to pop, and he wants to try to sell into this pop. And so really he wants to do this, but of course the problem with the 210s are they're only worth $30 a piece. Even when you multiply it by 60, that's only $1,800. So he can't do that. Okay, so he thought about what to do. He called me. This is what I told him to do, right? You sell a third of your shares at 190, 30 of your shares at 200, 30 of your shares at 210. You don't necessarily sell them, but you obligate yourself to sell them. You sell them in the future at those prices. The good thing about selling at the 190 is it sucks, but it brings in a lot of, premium. It sucks to have to get rid of some of your shares that low, but heck, it's only a third of your shares. And if it's going to have a great day and it blows past 190, it'll probably go past 200. But when it goes past 200, you'll get rid of the other third of your shares. That sucks, but it sucks, but at least you got a better price than 190 for a third of them, right? And you still got to keep $1.24 per share. All right, so the good thing about the ladder is, look at this. The ladder makes $11,000. So it makes more than just selling 60 in any one strike. It's the best alternative. And it's my opinion, it's the best alternative, but it's also the best alternative because it spreads your risk around. This is going to give you an average sales price of 200. Okay. This would give you an average sales price of 200 also, just writing 60 calls at the 200 strike price. Problem is this doesn't give Mark enough cash. He's short on the ring. All right. So the ladder, I think this makes a good case for a ladder, especially since he's willing to sell the stock anyway, but he doesn't need the cash right away. He's just trying to raise $10,000. I like this. I like this. Really, if he just honestly needed 10 and he didn't need 11, what he would do is he would do this. Watch this. He would only do 10 of these up here. Or say he would do less than these up here. He'd only do 5. Well, whatever. He would figure out what he would need to do up here. He wouldn't even need to do all of these. He would just need to do maybe 2. Whatever. He'd do none of these. Watch this. Exclude. Yeah, he could exclude those. He could just do 20, 20, and then he could remove these or just exclude them. And so he could just let the other ones run till expiration. So if the market does do something crazy and it goes up 30%, then he's not locked out. He's up another 170,000 The white line is what happened if he would have done it my way with the 3-strike ladder. So once you get into laddering, you can build all kinds of scenarios. You can spread your risk around. You can uncap your upside. You can do all kinds of stuff. So that to me is a real world example of a ladder that you might use in financial planning, retirement planning. I've done things like that before, exactly like that before. So now here's another example. That would be a great problem to have, but there are people like him, Mark, that have accumulated some wealth over the years, and they don't want to screw themselves and take too low of a price and sell all of their stock at a one lump sum. They want to sell the stock, but they don't necessarily need the money right away. Covered calls are a great use case for people like this. And I've advised lots of people like this. So on a smaller scale, this happens all the time too. Let's say you buy 10 SPY calls for Friday. You buy them on Wednesday, because the market's running. You think it's going to run into Friday. Okay, I've done that before. You pay $1 a piece for them. Okay, what I do as soon as I enter the trade, as soon as I get filled at $1 or $1, $1.02 or whatever, I put in a limit order to sell half the position, 5 of them at double. So I'll put in a limit to sell 5 of them at $2. Boom. As soon as that fills, even if I'm not watching it, then I have 5 free options. And then I might put in a limit to sell 2 of those options at maybe $3. Hopefully it's running. Maybe one option at $4, one at $5, maybe one at 10, or maybe don't even put in an order for the last one. Just let the last one run all the way to expiration and just take whatever it expires at. I just like spreading risk around. This is especially true when you're bullish on a stock and you want to squeeze a little bit more out of it if possible. When you're doing these covered call strategies, you do the latter, it has the effect of squeezing a little bit more upside out of it. You could almost think of SPY-T and triple QT. They aren't really doing ladders, but they're doing a little option trick to squeeze some more upside out. It's similar to doing a ladder. They're taking less money in return for more upside. So anyway, if you hate a stock, you're bearish on a stock, just sell the shares or write an at the money call. And because that's if you want to get rid of the stock, just write it at the money call, write it in the money call if you just want to get rid of it, or just sell the shares outright. And people do that. But when you have something, the more you like it, ladder it more, ladder it further out in accordance with how bullish you are on the future of whatever the asset is. Because the idea is you're trying to get the highest price possible, but you also want to get a fair price, and you don't want to totally screw yourself by taking too low of a price for all of it. So you want to spread it around and try to get a fair price or a fair range of prices. Okay. I think everyone gets the concept. That's the way I like to do it, but especially when you're doing stuff like retirement and estate planning, and you have 2 or 3 or 5 or $10 million worth of stock or more, and you're thinking about diversifying and putting it in this, or buying an annuity, or hiring talk to a couple of people you trust. It's free to talk to wealth managers. They'll talk to you for free. If you let them manage your money, they're going to get 1% of your wealth every year, but it's typically money well spent if you get a good one. But go speak with a couple of them and listen to their plans and see what they have to say. And don't listen to just people you hear on YouTube. But hopefully you guys can get some good advice from some of the things I say and some of the things other people say. But spread it around. Spread it around. That's what I say.